Hi boys, this is the last Memo video before I see you on Monday, and to be honest, I'm really excited to teach you guys face to face. Okay, so in task 10.10, they said the following balances appear in the trial balance of timber traders on 28 February 2009. We had vehicles with a cost price of 550,000 Rand, equipment with a cost price of 140,000 Rand. Then we have this contra asset account, accumulated depreciation on vehicles with 156,000 Rand. So what this means is that the vehicles in our business already lost 156,000 Rand of their value in the previous financial years. And we've got the same thing for equipment. So accumulated depreciation on equipment of 37,940, which means our equipment in our business already lost 37,940 Rand of their value in the previous financial years. Please don't get confused because it says trial balance on 28 February 2009. These accumulated depreciation values do not include the current year depreciation. We still need to go and calculate that because it's a year-end adjustment. Okay, remember that. So don't overcomplicate things. Then it says depreciation is written off as follows: 20% per annum on the fixed installment or straight line method. And then there's something that I want you to highlight. It says, note that a new vehicle was bought on 1 December 2008 for 160,000 Rand. This figure is included in the balance of 550,000 Rand above. In other words, this value includes the vehicles that we had from the beginning of the year, and it includes the 160,000 Rand of our new vehicle that we bought on 1 December 2008, which is in the middle of our financial year. Well, not directly in the middle, but it's somewhere in our current financial year. And this will affect depreciation of vehicles, which I'll go through with you very slowly when we get to that point. And then it says equipment is 10% per annum on the diminishing balance method. Okay, so that's important. It's not the straight line method, it's diminishing balance method. So now equipment will depreciate on its carrying value. Okay, so if we go and do the required part, which is just the same as 10.8 and 9, the recording and the posting, we will start in the general journal. Now you guys know by now that we only have one journal voucher for depreciation. It's at the end of February 2009. The account debited as an expense account called depreciation, which is in the nominal section. And then vehicles depreciation will go to the credit side of accumulated depreciation on vehicles, which is a contra asset. So it's still in the balance sheet section. And then the depreciation for equipment will be credited to what we call accumulated depreciation on equipment, also balance sheet section. Okay, now we only have one depreciation debit. Remember, we will add the total depreciation from vehicles and equipment together and debit it to depreciation. It must always look like this. Okay, so don't have two separate journal vouchers. Now, when we go and depreciate our vehicles, we will do it like this. In a scenario like this, where we already had vehicles when the financial year started that needs to be depreciated for the whole financial year, and we bought a new vehicle throughout the financial year, somewhere in the middle, that needs to be depreciated only for the amount of months that we had it in the business, the easiest way to do this is to use a timeline. Okay, so what I would recommend is that you draw your own timeline. This is now fancy schmancy with PowerPoint, but you can just draw a nice line indicating that the year started on the 1st of March 2008 and the year ends on 28 February 2009, and you've got your 12 months. Then you will see that for the first 1, 2, 3, 4, 5, 6, 7, 8, 9 months. Okay, for the first 9 months, the vehicles in our business was worth 390,000 Rand. Because remember, they say to you that the 550,000 Rand includes the 160,000 Rand cost price of the new vehicle. Okay, so the vehicles that we had from the beginning of the year was only worth 390,000 Rand. Then they said on 1 December 2008, which will be here, on 1 December 2008, we bought the new vehicle of 160,000 Rand. So now suddenly our total vehicles have a cost price of 550,000 Rand. So what you do is you do two depreciation calculations. You do one for the old vehicles and you do one for the new vehicle. And then at the end, you calculate the total depreciation for vehicles. Okay, so the old vehicles, the 390,000 Rand worth of vehicles, we had in our business for the whole year. We had them when the year started and we didn't sell them somewhere throughout the year. So we had it for the entire year. So if you want to calculate the depreciation on cost price, you would say the old vehicles had a cost price of 390,000 Rand. The depreciation rate is 20%, and we had this vehicle or these vehicles, we're not sure how many vehicles this represents, for the full 12 months in our business because we had them when the year started and we didn't sell them. Okay, so they lost 78,000 Rand worth of their value. But for the vehicle that we bought on the 1st of December, we will only depreciate it from the 1st of December until the end of February, which is 1, 2, 3 months. Okay, so the new vehicle with a cost price of 160,000 Rand will be depreciated at a rate of 20%, but it won't be depreciated for the full year because we only bought it on the 1st of December. So it will be depreciated for December, January, and February, which is the 3 months. And therefore, this vehicle lost 8,000 Rand of its value. So if we want to know what the total depreciation is for our vehicles for the year, remember, we look at it at an asset class. Okay, so we want to know how much we lost in value for all of our vehicles throughout the year. Then you just add the two together to see that our vehicles lost a total of 86,000 Rand. And this is the value that we will credit to accumulated depreciation on vehicles, and that will be part of the depreciation expense for the year. Okay, so then that value goes to the credit side of accumulated depreciation on vehicles. And then when we go and calculate the accumulated depreciation on equipment, there's no extra explanation necessary. Just remember it's on the diminishing balance method. So now we calculate depreciation on the carrying value using the given cost price and the given accumulated depreciation from that trial balance. And we don't use the cost price. And then the 10,206 goes to the credit side. And then when you add these two values together, you will get your total depreciation for the year of 96,206, which goes to the debit side of depreciation. Nothing goes to the debtors and creditors control columns because none of these will actually affect our debtors and creditors. And then remember, your journal narration has to give the depreciation percentages, the class of the asset, and the depreciation method. Okay, so it's 10% per annum on equipment on diminishing balance and 20% per annum on vehicles on the straight line method. Then when we do the posting, the first thing that we need to remember is that they gave us some opening balances that we got in our trial balance. Okay, so the vehicle's opening balance was 390,000 Rand on the 1st of March 2008, so when this financial year started. Why is it 390,000 and not 550,000? Because they said in the information that the figure is included, the 160,000 Rand of the new vehicle was included in the 550,000 Rand above. Okay, so this is not our opening balance. This minus 160,000, which is 390,000, was the opening balance. Then equipment had an opening balance of 140,000 Rand. Accumulated depreciation on vehicles, which is a contra asset, in other words, it's the opposite of an asset, so we work on the credit side, had an opening balance of 156,000, and accumulated depreciation on equipment had an opening balance of 37,940. Okay, then somewhere throughout the year, on the 1st of December, we bought that new vehicle. Don't forget to record it. They didn't specify that we bought it and paid for it in cash. Okay, but we can just assume that it's cash. So it's bank CPJ, 160,000, which then brought our vehicles to a total of 550,000 Rand. Okay, and then the only thing we still need to post is the depreciation. So the debit leg of depreciation will go to the depreciation expense account. But now remember, in the general ledger, we split the two entries because they are separate contra accounts. So we will first deal with vehicles, and then in a separate line, we'll deal with equipment. So the ledger is different to the general journal. In the journal, we add them together. In the ledger, we split them. Okay, so 2009 February, the last day, we had accumulated depreciation on vehicles in the general journal for 86,000 Rand. And this also went to the credit side of accumulated depreciation on vehicles. And I highlighted them in blue so that you can see the two go together. Then for equipment, the debit leg will also be in the depreciation expense account. Okay, bringing our total depreciation to 96,206 Rand. And the credit leg for the equipment depreciation will go to accumulated depreciation on equipment, bringing the total accumulated depreciation on equipment at the end of the year to 48,146. And for vehicles, it was 242,000. I just forgot to mention that. Something I hope you've noticed is that, remember, because the closing balance and the opening balance is not in the same calendar year, you have to write the year again, 2009 Feb. Okay. And then lastly, the effect on the accounting equation of the depreciation, we'll use the total depreciation value. We will say our assets lost its value even though we didn't record it in the asset accounts, okay, but we recorded it in contra assets accounts, okay, which is negative assets. So our assets lost value of 96,206 Rand, and then our owner's equity also lost value of 96,206 Rand because depreciation is an expense, and expenses always decrease owner's equity. Nothing happened to our liabilities. Why did I not record the 160,000 Rand that we spent on the new vehicle? Because they very specifically said only show the effects on the accounting equation for the depreciation. Okay, and that's it. See you guys on Monday.